So my name is Danielle Shay. So nice to meet all of you. I'm the director of options at Simpler Trading. I'm primarily a technical analyst. I use a lot of Fibonacci as well as trend following strategies overall. And then also, I am an expert commentator. I do some regular TV bits here and there, and I also like to post some ideas on Twitter. So those are all the different places you can find me. Today, I'm primarily talking about the run into earnings. So for me, in the options market, and I do trade stock as well, but I trade primarily options. My favorite times to trade are going to be the 4 to 6 week span of time before earnings season. So in the options market in particular, it's really important to time it properly because of the way that options are priced. With options, unlike stock, you can run out of time. So when looking at an earnings season, these are the three key components of that, right? So you have the beginning, which is going to be the phase one, the run into earnings, and that's primarily what we're going to talk about today. I do also do the other two phases. I like to trade the report in the options market, but I particularly love to trade the after earnings plays as well. So this presentation is just going to focus on the initial run into earnings. The reason why is because out of these three phases, this is the one that I find to be the most consistent and the most lucrative. While the others can be fun and exciting when they work, they're not as high probability as the run into earnings. So that is why I primarily focus on that one. Looking at where we're at today, I mean, today is April 24th. But I mean, really, this is relevant at any point in time. Yes, it's relevant right now because we're really getting into the meat of earnings season this week. But, of course, this comes around 4 times per year. And so the more that you can work on the strategy and hone it, the better you get each quarter. So this week in particular, when it's the week of FANG earnings, can get a little bit crazy, but it's also a good time to look for some of these different trades. So for the trade setup, the way that I primarily trade it is I like to trade it with options for a couple different reasons. Number one, I mean, obviously I like the leverage. Number two is because of the way that options are priced. So because of the way that options are priced, you get an increased bump on your money that you wouldn't get in stock when it comes from the implied volatility. So I like to trade it, really just with basic long calls. I'll trade it with butterflies. Straddles also work if you want to make a neutral trade. But I also will trade it with stock as well, kind of building up into a stock position, especially if I'm looking at something that I want to hold through the report. Typically, with my options trades, I'm not going to hold it through the report. I just trade, 3 weeks prior, and then you have the report right here, and then I get out. Whereas if it's a stock trade that I'm looking at, I will generally look to continue to build up positions. Like, for example, CRM, Salesforce is one of the ones that I'm doing where, you start 3, 4, 5 weeks prior to the earnings report, you get the report, okay, then it settles down again, you add some more before the next one, something like that. So here are just a couple different comparisons that I like to look at. At the end of the day, all of the analysis that I do is based on the underlying stock chart. So, I'm always looking at primarily the daily charts, and then I will go down to lower time frames. But the main reason why I do like to trade options is because you can trade in a directional or neutral manner. But the primary reason here is because you have a much lower capital investment required. So typically, I can play with a lot less money than I would need if I'm building a longer term stock position. I also like the different option strategies that I can use. I like to do, you have conservative option strategies, you have aggressive option strategies. So you're really not stuck in one, you're not stuck in one thing where you're just doing something really aggressive all the time. So as I've gotten more into my options career, I specifically like to use much more conservative strategies, so you don't get a whole lot of craziness. Are there any questions so far? Are we doing good?
No, I think we're probably good right now. I do think it's interesting, though, that you mentioned, Danielle, that there are aggressive option strategies and there are conservative option strategies, because I think a lot of folks think of options and they think, well, they're too risky for me. But there are strategies actually that produce less risk. And so I just wanted to point out, I thought that was interesting that you pointed that out to everybody.
Oh, definitely. And I mean, I think in the beginning in my options career, I did a lot of just buying long calls and spreads, which can be a little bit more risky. But as I've gotten more into it, I particularly like to trade butterflies and unbalanced butterflies because they are so much more conservative. And they hold a lot better through different fluctuations in price rather than something like a long call that can lose its value quite quickly. So, there's really just a lot of options. Options.
I got that.
So when you're looking at the pricing of options, here's the primary variables that affect the price of an option. Number one is the price of the underlying stock. I mean, that's very critical. The second portion that you have are how many days until expiration. Typically, when people trade options, the way that they lose money is they don't give themselves enough time. So if you buy something that expires in a day or two or in a week and your stock hasn't made its move yet, then yes, it's going to lose its value, because the way that options function is they have a value, and then as it gets closer to the time of expiration, they lose their value. So you have to give yourself enough time. The third portion of this that's particularly helpful during the run into earnings is the implied volatility. So options, a component of their pricing is based on how volatile the stock is going to be. Now, because we know when the earnings dates of the stock are, and of course they know that when they price options, what happens is that the implied volatility of the stock or of the option will rise going into the earnings date. So maybe like 3 or 4 weeks before the earnings date, the implied volatility is pretty low. And then it will start creeping higher as it gets close to that earnings date. And that's literally just the way that it functions. And because the implied volatility is a key component of how the option is priced, it makes the price of the option go higher. So this is a typical pattern that happens every single quarter. And so the good part about it is that that's what's going to happen. So this means a few things. It means that number one, options cost more when the volatility is high, i.e. around the earnings report. So number one, we always tell people in our options room, I mean, you never ever go and buy long calls directly before an earnings report, because the reason is they're basically just incredibly expensive. The price is juiced up. And then what happens after the earnings report is that implied volatility drops and the price of the option will drop. But if you already know this, you can use that fact to your advantage. So what you try to do is you come in and you say, okay, well, if I know that the implied volatility is going to rise going into earnings, that's one key component of the price of the option that'll make the option's price more expensive, right? So if I instead buy it before the IV begins to rise, a couple weeks before the report, then the price of your option is going up, right? And if you also buy the options on a stock where the price is also working in your favor, then you have kind of a double whammy, right? Because you have something that the price is going in your favor and the implied volatility is going in your favor. The one thing that never goes in your favor is the days till expiration, because, I mean, obviously you can't go back in time. So you look at these two factors to kind of negate this one right here. So that's the entire purpose of using options. to trade this strategy. Now, obviously, there's a lot of different components of that. It would take me a really long time to get into all of it. But basically what I'm looking at are in the money options, at the money options, or out of the money options. Depending on where these options are in the option chain, they'll cost you a different amount of money. Typically, I like to stick with these and these just because they, even though they're a little bit more expensive, they hold the value a little bit better going into earnings. Now, obviously, I'm sure you've heard of a lot of different positives and negatives surrounding options. Yes, I mean, it's definitely a lot riskier than trading stock for sure. They are priced so that you will lose money. That's the entire, point of how they do it. But if you know kind of like those tricks around it, then that's the goal, and that's kind of what you're focusing on. Because with options, what you have to do to make money is you have to get in at a time where there's a greater than expected move. Without doing that, then they're kind of priced to lose money, right? So you have to be able to identify moments in time where price is going to expand, such as the run into earnings. So here's just another graph of the different option strategies that I like to use: out of the money calls, in the money calls, debit spreads, credit spreads, iron flies, butterfly, buying stock. And then I kind of make a graph here of the least risky to the most risky, just based on how much I like the setup and whatever risk I have on at that time. So I kind of cycle through those different ones. So basically, I mean, here's just the concept that I was talking about, but essentially, if you have an earnings announcement right here and you're looking to buy an option, then it's going to continue to rise in volatility. So the blue part right here is the volatility, and that's a major component of that options price. So it just kind of trades higher going into the earnings report. And here's a couple of examples on the actual chart. So Amazon is one of my favorite ones to do. And I always look at this and I tell people, just like any trade setup, it doesn't work 100% of the time. But if you look at it in the last 7 out of 8 times or the last 6 out of 8 times it works, then, I mean, for me, that's more than enough. So, taking Amazon, for example, and then highlighting the earnings dates here, and then looking at the amount of times that it has rallied directly into an earnings report, that's exactly what I'm looking to trade. Now, this one, of course, that one did not work. That was during that, correction that we got last fall. But for the most part, Amazon is one that I trade every single quarter, primarily with butterflies and put credit spreads. The next one that I love is Microsoft. This one's pretty consistent, slow and steady. I also trade this one with stock, and I love to add stock on any pullback in Microsoft. I mean, this thing is just a beast. Is that one of the ones that you look at for the run into earnings?
Yeah, I mean, I think Microsoft is a great looking stock, but there was a question in the room. I think this is a good time maybe to bring this one up.
Sure.
The question is, why would you buy the stock when you can also have a synthetic stock using options? Why wouldn't you just stick with the option? Why would you do both?
Because I have a variety of different accounts. So with basically just money management, I mean, everybody looks at options and says, hey, options is risky, which it is. So that's why, from a money management perspective, if I have, 100K or whatever, then I'll have 25K in my options account. And then I have the rest, 75K, in long-term stock. And so this is kind of the, slow and steady wins the race. And this is the one that you're kind of like, okay, well, I'm going to try to double this. So I don't like to have all of my capital in options, even though I do love to trade options. And so what I do is I add the long-term stock to the slow and steady accounts, and then I'll aggressively trade it in my options account. And I think that also helps you to, it helps your options trades be better, because if okay, this is, from a risk perspective, this is a quarter of my capital. And then from that, if you're risking half of that at any given time, then I don't know, it just makes you a better trader, I think.
Right. Well, I've got a question for you. Do you know how to guarantee to get to $1 million trading options?
Oh, guarantee. Hey, if I knew a guarantee on that, I would be on a mountain or a mountain, top of the mountain somewhere in a cabin. I think that the best thing to do and what I do is I like to cycle my money out. So I think trading options, the hardest part about it is actually making money because you get into, especially like the past 3 weeks, you get into kind of a thing where you're just used to seeing it's just so fun to buy a call and watch it double overnight. And that type of thing is kind of addictive. It's kind of like gambling, right? And so I think the worst thing is when you're on a really good streak and you have to take money out. So for me, what I do is I cycle money out of my options account, whereas with my stock account, I just leave it in there and let it grow. So by coming in and taking your profits on stuff like that and putting it somewhere else, for me, I've found really helpful, because what happens is when you start making a lot of money, then you get more risky and more aggressive. And that is what prohibits you from essentially making your $1 million.
Well, that was actually a joke, Danielle. I was gonna say you have to start with 2 million.
No, but it's true. I mean, it's like people ask me that and it's just like, it's hard when you're in a good streak and that prohibits you. So
Yeah, I just know for me personally, I think it all comes down to how people can manage their own emotions.
Oh my gosh, exactly. That's exactly it. Yes, managing your emotions.
Because you can lose a lot of money. I mean, and that's the thing. Sometimes you hit a couple of trades, and believe me, I've gone through it. Maybe you went through it at some point, but I know I've traded options before. I stopped trading them because I know my mentality and I know where my weakness is. And when I hit 2 or 3 of those options in a row, all of a sudden I feel invincible. And sometimes I start getting a little bit too aggressive, and then it would come back to haunt me, because as soon as you start maybe taking a little bigger position, or maybe doing some strategies that are a little more aggressive, that's when the trade goes against you. I can promise you I had some of those.
Yes, that's exactly right. And so my boss, John, he calls that kind of the mental plateau. And so that's why he's always told me just keep wiring money out, and then that way you try to avoid that. But so far that's what I've been doing. And
Do you use stop losses? That was a question that came in from the room. I mean, are your strategies such that you're already protected to the downside, or do you use stop losses to protect?
So it kind of depends. It depends on how much money I'm putting into a given trade. When I do cheaper trades, such as butterflies, and I'll spend $1.50 or $3, which is, $150, $300 per contract. For me, that's a pretty low risk. So for something like that, I won't have a stop on that. But if I'm doing a more aggressive strategy, for example, like buying long calls on Adobe, these are going to cost you $14, $15, $16 a piece, which translates into about $1,400 per contract. So for something like that, that's more aggressive, then yes, I have a 50% stop loss. But for the more conservative trades, generally I'll just let them go and I will risk what I'm willing to lose for my stop loss.
Okay, fair enough.
Uh-huh. Yeah, because the thing is in the options market, because it's so because it can be quite a roller coaster ride. The problem is that if you have a very close stop, you will never give yourself the opportunity to make your profit. So learning how to sit through the fluctuations is really important. And so that's why we actually usually say that we want you to risk what you're willing to lose, so that you're able to learn how to sit through those fluctuations so that you can get to this point. Otherwise, if you just have a stop here, I mean, you're just, you're never going to get anywhere.
Gotcha.
Yeah. So here are the main points of this overall setup. I mean, the basic idea is taking advantage of the bullish sentiment leading into key earnings dates, Like all setups, it's strictly technical, but it's mixed with a bit of fundamentals. So the main things that I look for is a solid trend. I want it to have a solid uptrend over at least the past 6 to 9 months. Because of the correction last year, I give it a little bit of a break sometimes, but that's generally what I look for. I want to see price holding support and resistance. We use the voodoo lines at Simpler Trading, but Fibonacci moving averages, I like that as well. I love a squeeze. Some of you may be familiar with that. Basically, it's just looking for consolidation that's going to pop. So in the options market, it's very important to get a greater than expected move. And then I also always want a solid entry point. I always want a pullback buy, always. Like no matter what I'm doing, I want a pullback buy. And then the fifth part of that, I call that the umph. This is when you have the fundamental backing behind you. So all of the technicals are great, but I also really want the fundamental backing.
That last one you showed there, if you can go back. You show a strong techie name. There was a question also that came in and asked about the types of stocks that you like to use options on, and specifically they were asking about technology or whether big names.
Yes. So I call those the Phoenix flyers. So it kind of will shift around depending on, whatever's going on in the market. But right now, my favorites are the Cloud Kings. Love the Cloud Kings. I love cybersecurity. Those are pretty much my favorites. I also like the semis. So what these are the tech names that are outperforming the market. So again, in options, to make money, you have to have greater than expected moves. And like Xilinx, you were talking about Xilinx earlier. So one of my best trades this year was on Xilinx because, that thing just exploded, right? And so those are the primary lists that I will trade from on an aggressive standpoint. I also love the market leaders, the FANG stocks, Microsoft, Amazon, Google, Facebook, Netflix. I trade those over and over again. So for the run into earnings, those are the ones that the run into earnings works because there's hype going into the report. And so if you think of it that way, and if you think, okay, well, why is it trading higher going into the report? Well, because people are buying it in anticipation of a good report, right? So what industries have the most hype? And then you look at it that way, and then you can narrow them down based on the technical and fundamentals.
All right, follow-up question.
Mm-hmm.
All right, so Xilinx, you said you've traded that one. And of course, Xilinx is reporting after the close today. This is a stock that in the last 7 weeks has gone from about 117 to 140. Obviously, the volatility, that implied volatility, is going to be high. What would you think of a covered call strategy if you own the stock? That was another question that came out of the room.
So I would not personally sell covered calls on Xilinx before a report. The main reason is because of, this has just been a phenomenal run right here. So I would not sell covered calls on something before a report. What I would do with this, you have to make a decision, if you're going to actually trade the report or not. For me, if I was going to do something on this, I would have to sell like a bullish put credit spread just because this pattern is incredibly strong. The fundamentals on this are very strong. It's one of the most solid ones in its group. I call it a phoenix because it rose from the ashes with incredible strength. Last December when everything was completely eating it, Xilinx was just like, oh, I don't really care. I'll just hang out for a minute, and then boom. So my favorite trade on Xilinx this year was, I call it the 2x move. So you have a market maker expected move on this ticker, and that's going to be about $10. So you have a $10 expected move, and what I look for is on the report, I want to see how much it actually moved. Okay, so I don't remember what it was last quarter, but whatever this move was, it was 2 times the expected move. So when a stock does that and it moves twice what it's expected, generally what you get is a momentum follow through to the upside. And so what you see is a breakaway gap that was never filled. So for me, that's incredibly strong. I wouldn't want to sell anything up here because of that strength. However, if you wait for after the report, maybe you could do something with it then. But with a pattern like this that has gap, runaway gap, 2x move, it's going out on a high right before a report, I can't look at that as any other way than bullish. And if for whatever reason, if it doesn't perform as well as it did last quarter, and if it falls down a little bit, that to me is a sale, sale, sale. And I would just buy more.
Mm-hmm. I agree.
So,
What do you do with the wide spreads on options? You try to take advantage of that?
so the wide spreads on the options are kind of a pain. These ones aren't bad. I mean, this is, about not even 50 cents. It's really not too bad. What I try to do is I come in the middle. So if there's a bid and the ask, you just try to get that mid price in here. For something like Xilinx, the bullish trades that I would typically do are just sell put credit spreads going into the report. However, I don't really like to do that when it's going out on a high extended off of the 8 EMA, just because it's a pretty aggressive trade. For me, what I really like to do with something like this is just wait, because after the report, something like that, I mean, this was one of my best trades of last earnings quarter, because if you buy that on the gap up and then it just takes off in options, I mean, that's a lot of fun. So that's what I like to do there.
That would definitely be fun.
It's very fun when it works, for sure. I'm always on the lookout for the gap ups after an earnings report, but it has to be on the same thing, like one of those strong names that I would already do the run into earnings on.
Okay.
Yeah, so I mean, I'm just going to go through some of this quickly, just because I had already picked out some names in here. I mean, I went over the basics of the setup. And I don't know if y'all give out slides, but I'm happy to send you the slides if your members want to download them. But basically, you're just looking for technical setup, strong support and resistance. I love the squeeze. I love to look for consolidation that's going to break out. That really helps the run into earnings. I always want to get in on a pullback buy. So I use just the basic moving averages, 8, 21, 34, 50, 100, and 200. I usually like a pullback to the 21 or the 34 for my entry. A big part of the setup is looking at the fundamentals. And so I like to use both Chaikin Analytics and Investors Business Daily. And, like we've been talking about, you want to focus on what is hot. The reason why it works is because it's hot. Cloud King, cybersecurity, artificial intelligence, market leaders, those ones are the ones that are hot. Those ones are the ones that have the hype. And then I also like to look at, whatever sector is strong at that moment. So I do a lot of different sector analysis. Obviously, tech has been really bullish. Industrials have gotten a lot better after the hit that they took last year with all the China news. And so I like to focus on stocks within the hot sectors. Stuff like utilities, not really looking at for a run into earnings. Consumer discretionary has been great, but it's almost ran so far that it's just, there's only so much more it can go before you're going to see some rotation. Haven't seen it yet, but it's something that I'm looking for. But consumer discretionary, Nike, Home Depot, Amazon, I love trading those top weighted products going into the report. So this is basically just the, breakdown of it. Just want the trend, directional calls. It's the best way to take advantage of it. I like it about 3 to 4 weeks ahead of time, but it has to be on a pullback. I will have a 50% stop loss if it's a long option and if it's an expensive long option. I consider anything above about $6 or $7, which is $600 to $700 a piece, to be more expensive. The cheaper ones, I tend to just go into it with what I'm willing to risk. The profit target is always Fibonacci extensions, but at the end of the day, I'm always, always, always getting out before the earnings report. So here's just a couple of different parameters for the options trades, the different deltas. It would take a while to get into that, but I'll just, it's in the slide deck, so I can send that to you, like I said. But generally just doing a mix of in the money or out of the money options, depending on how long I have, depending on the pullback that I got, depending on how much I like the stock. And so, like I said, I just look for a combination of the hot industries. I use Chaikin. Here's a list from Chaikin that I pulled of these are the strong bullish NASDAQ names because, they're within the tech space. And then I combine that with the technicals. So because of the, today it's the 24th, Microsoft earnings is already coming out today. We talked about some of the ones that I did before, Microsoft, Amazon. I'm in one for Google right now, Facebook and Apple. Those ones have already, taken off. Netflix is usually good this quarter. It stayed in consolidation until the report, but typically do like Netflix. Here are some of the ones coming up that I'm looking for. I'm in Zen right now. Alibaba is one of my favorites. Alibaba and Adobe. These are ones that I generally do every single quarter. Home Depot is actually pretty good as well. And these are some that I'm looking for. So CTSH, F5, O'Reilly, INTC, INTU, Salesforce, MDB. This is a new cloud name that I like. Cloud and Cloud. So I also really like credit card companies, payment processors, MasterCard, Visa, American Express are pretty good. PayPal, I like. PayC is a good one. And then here's just an example of the overall chart pattern that I'm looking for. What I'm looking for is something that was able to recover really quickly after the December correction. This is a chart of Zen on the daily chart. I'm looking for something that has stacked moving averages. You have price above your moving averages. You have nice steady pullbacks. This one in particular has a two-step pattern, which is a fib pattern right into a level of symmetry support. And then the squeeze is the consolidation. So this is just the TTM squeeze. This is my number one indicator that I use for identifying explosive price movements. And then basically, you're just looking to buy this thing on the dip. So Zen is one that I'm in right now. It has earnings next week. You just buy it on the dip down to support, and then you look to trade that right into the earnings report. So just to conclude, and then we'll have a little bit of time for questions. Even though I do trade options and it is, more risky, you really do have to understand that it's a leverage tool. It is more risky. And the main reason I like it and the reason why I started doing it is because you can do it with less capital than what you need for, your stock account. So it's just important to use them correctly. I would never, ever, ever advocate anybody just going out there and saying, oh, well, I'm just going to, try and buy a bunch of options right before an earnings report or whatever. If you're going to put your money in something like that, you really do need to know what you're doing, and you need to learn how to limit risk. So if it's something that you're interested in, definitely don't just, start slinging trades. And the other thing is I like to paper trade. I paper traded for 2 years almost a year and a half before I used the real money. So that's also something you can do if you're interested. And then this is just my final, final page here, different places you can find me. I have a free newsletter at 5startrader.com. I teach classes, and then I'm also in our Simpler Trading Options room, and then I have a membership for beginners at Simpler Foundation.
That was excellent. There are a couple of questions I want to follow up.
Yes, I would love to answer the questions.
Well, one was came in earlier about, not understanding options and wanting to get some education and so forth. And you said, you paper traded. Obviously, there's a big learning curve with options. What would you recommend to somebody who is looking to get into options or at least learn more about them? Where would you go?
So within the different services that I do, 5-Star Trader is good. This is just a free e-letter that you can sign up for, where I talk about my stock picks, different trades that I do. It's just, it's a newsletter. I do teach classes. with that you can find here at simplertrading.com/store. But I think that the best place to start is just a membership at Simpler Foundation. So within Simpler Foundation, I am the head of that, and I do a couple different videos per week based on learning about options, how they work. I have a full learning center in there. I also do a weekly Friday video where I go over a couple of different options trades, and within that, I always, I try to stick with the most basic ones so that people can learn the concepts, right? And so that's a pretty good place to start out. I have a section in there called Dear Simpler, where I create videos where people ask just exactly that, how do you get started options trading? People ask me all kinds of stuff. What about the IV crush? What do you do for earnings season? This is one of my colleagues, TG. How do you do pinning plays? This kind of stuff. So people write questions in there. So I think that Simpler Foundation is a pretty good place to start. And then I do the playbook as well. That's my weekly review. Our options membership at Simpler Trading, we run a trading room all day. It's not the best place to start for beginners, but that is my primary duty that I do. So I generally do an hour per day in the trading room, where I do all types of options trades. But if you want to get started, the free one is a newsletter, and then if you're interested in a membership, then I can get you a deal for like $9 a month. It's pretty cheap. So
awesome.
Yeah.
Okay, one last question.
Of course.
This goes back to your trading of options. There was a question that came in and asked about what expiration time do you usually use? So you said, obviously if it's close, then, you don't have much time to make your trades. But do you look out 30 days, 60 days, 90 days? I mean, what would you typically look at?
So it completely depends on the setup. And we can use that other one that you used as, what was that ticker that you gave me? FLDM?
Yes. And full disclosure, I own this one. So tell me.
So he gave me this one. I really like this one. I think the pattern's great. It looks awesome. So for the setup that we're talking about, the run into earnings in particular, the thing that's important about it is you have to buy the options in the series of earnings. Because of the way that the IV increases going into earnings, it increases the most in that series. So you have to look at your options chain and say, okay, well, if the earnings is on May 2nd, that's going to be in this series right here. So you see how the IV is at 71% here, and on this one that's after earnings, it's at 59%. Normally you would think, oh, well, I want more time, right? Yes, normally you would. In a normal directional setup, I would go about 30 days out. But for the run into earnings, you don't want that series because this is the one that has the increasing IV. So with that one, you would look to do something like this. And I mean, this is really cheap. I'm going to do this one in the trading room later. It's $1.30 per contract. So something like that is right in my wheelhouse. Just look to get like three of those.
Are we splitting this when you buy this? Or are we going to split?
I mean, it's no, I mean, this is what I do all day in the trading room. So we look for ideas, and I love that idea. I'm going to show my trading partner that one. But another one that I really like is Alibaba. So for example, same thing here. This one typically has a good run into earnings. It's a little bit early to start it. It's 3 weeks ahead of time. I would prefer a better pullback, but same thing here. I mean, you just look for the earnings series, which is going to be this one right here. So it's the one with the high IV. So right now it's 35%, but that thing will get up to like 80% at least. So if you go down, and these are much more expensive. So for this one, these Delta 70s are $11 a piece. That's going to be, the other one only cost you $1.50 or so. This one's costing you $2,300. The other trade was only like $240. So for something like that, yes, I would definitely have a 50% stop loss because it's very expensive. But for the other one that costs $1.40, I would just put it on and let it go.
All right. Well, when you go back and you're talking to your partner and you're in your trading room and all, just remember to give credit where credit is due.
Oh, I will. I will tell them for sure. I'm gonna be like, they found this at StockCharts and it's amazing. Yeah, a lot of our members really like your site, and they keep telling me that I need to use the what's that called? The seasonality.
Yes.
Yes. So our members were excited. I told them I was coming over here today, and they're like, "No, you're not leaving, are you?" I'm like, "No, I'm not leaving. I'm just doing the thing." So, yeah, they're looking forward to it. A lot of our members really like StockCharts. They like your service, and I think it would be really cool to do a couple more things together.
Okay. Yeah, that would be awesome. Just be sure when you tell them where this came from that you don't tell them that it was a blind squirrel theory. That's
awesome.
Well, and before you leave, Danielle, definitely email me the link to those slides, and I'll publish them in our recap tonight, because I know a lot of viewers will probably want to look at those.
Yes, definitely. I can do that.
Yep, just Erin H at StockCharts.com.
Oh, great. Okay, cool. I will do that. I will definitely send you over the slides. I know how helpful it is to have slides to look over.
Absolutely.
And Danielle, it is always a pleasure to have you on the show. We really don't talk too much about options, so this is fascinating and very interesting, I'm sure, for a lot of our viewers. So thank you so much for stopping by today.
Oh, thank you so much. I really appreciate you having me.
Oh, we'll definitely have you back.
Awesome. Let me know. I'll be back.